All right, guys, I'm going to jump in as people continue to hop on here. As everybody knows, I'm Matt Greene with Coldwell Banker. I'm excited about this discussion today. I feel like this should be top of everybody's mind. I feel like it can be an overly broad question. So what we wanted to do for you today is really tackle this from 5 different angles. I'm going to be looking at the fix and flip market. Todd is going to be diving into the rental market. Conor is going to share with us what he's seeing in construction financing and hard money loans. Connie is going to be giving her perspective from the title world. Obviously, she gets to see a ton of buyers who are closing, what sort of products they're using. And last but certainly not least, Sean is going to be addressing what's happening in the mortgage world, where are rates going, all of these questions that all of us want to know the answer to. So first of all, thank you guys. Thank you, Todd, Conor, Connie, and John for joining us. And thank you, Conor and Connie, for being sponsors of Grid Philly. We really appreciate your support. What I have done to kick things off is I wanted to look at the most recent data that will give investors a really good idea of where to invest in flips. This goes for builders and developers, and where they're likely to lose a lot of money next year. So what I've done is I've looked at the past 30 days of data. This is from November 7th to December 7th. So this is really hot off the presses. I've eliminated condos because that's a whole separate market altogether. So I've limited this to single family properties in Philly from $200,000 all the way up to the highest under contract, which is about 2.6 million. And the reason I eliminated properties under 200K is because by and large, those would not be end user properties. So I kind of feel like that skews the numbers if you include those sales. So I found some really, really surprising information. First of all, there have been 578 properties that have gone under contract in this 30-day period. Now, that may not mean a lot to you guys. That number is actually down about 40% from where it was last year. But for everybody who has heard or who believes the notion that the real estate market just comes to a screeching halt over the holidays, 578 sales is 578 sales. You know, if you're a developer out there trying to sell a property or a seller trying to sell a property, obviously all you need is one of those buyers. So there are still transactions taking place every single day. But what I wanted to get at for all of the house flippers and all the builders and developers out there is, where are the sales taking place and what is the sweet spot with regards to prices, right? And what I found was kind of surprising. First of all, 92% of the properties that have sold in the last month have been under $700,000. So the first thing that I would say to anybody out there that's involved in a construction project or about to start a construction project is, if you are, shooting for an end value that's over 700,000, at this moment in time, you're only chasing about 70% of the market. That's a much higher risk project than under 700,000. The second thing I found, which I thought was surprising, is almost half of all properties that have gone under contract are between $200,000 and $300,000. Now, that's a little bit of a problem if you are flipping property, because typically house flippers are chasing anywhere between a 15 and 20% profit. So that's $40,000 to $60,000 on a $200,000 to $300,000 flip. That's a little scary, because anybody who's ever done a renovation knows that if you run into a surprise along the lines, and there are almost always surprises, and that surprise happens to come with a $15,000 or $20,000 price tag, half of your profit or a third of your profit, or even more than that, sometimes in some cases all of your profit, can be eaten up. So what I would say to people out there who are about to flip a property or who are looking to flip a property, the $400,000 to $500,000 price range right now is looking to be the sweet spot because there's enough transactions taking place in that price range, and also there's enough profit involved in that large of a project that, you know, if you run into some areas where the budget takes a little bit of a hit, it's not going to completely, you know, decimate all of your profit. Somebody have any questions on that so far? All right, so
that's all awesome data pieces, Matt. Thank you for that, because that's very targeted that we can go after.
Yeah, no problem. The second thing that I wanted to show you guys, I'm a visual person, so let's see here. All right, can you guys see this, the canvas screen? Yeah? All right.
Yes.
So this is just going to be really short, sweet, and to the point. Here are the sales that have taken place. You can see they're in 3 general areas. We've got Center City, Northwest, and Northeast. All right. No huge surprises there. Not a lot in West Philadelphia. Not a lot in North Philadelphia. If we look at this on a more micro level, you know, and again, I'm just looking at where
the screen went away, unfortunately.
Oh.
It just says click to exit.
Full screen.
What am I doing here? Resume share. Stop sharing. Sorry, guys. I might just have to talk through this. Let's see. No. I don't know what's going on here. All right. Well, I'm going to hide that for right now. And I'll just talk you through what I found. So the concentrations of sales are occurring in the Northwest corridor, meaning Manayunk, Roxborough, Mount Airy, Germantown. The Northeast corridor, starting from Connie all the way up to Torresdale. So those areas are tending to be very, very active right now. South Philadelphia along the Broad Street corridor. So whether that's Newbold on the west side or Passyunk Square on the east side, very, very strong in terms of sales, as well as Pensport. What's not doing so well are, number one, Brewery Town, you know, which was a real hot spot for people looking to develop and flip houses. You know, not so many transfers happening there. West Philadelphia, a smattering of sales happening there. Point Breeze, you know, used to be Philly's hottest spot, not anymore. Please don't send me hate mail, but not a lot going on there, guys. It's been oversupplied for a really long time. And then, you know, once you get into the northern corridor of Broad Street, you know, around Temple, West Kensington, those are the areas where you're going to see some really shiny, sparkly, what appear to be good deals next year. And there's just not the sales activity to support it. So, you know, anybody that's looking to flip property, definitely consult with a skilled professional. Feel free to reach out to me if you need any recommendations, but there are definitely areas where people are going to make a lot of money next year and locations where people are probably going to lose potentially a lot of money next year. What questions do you guys have?
I have a question. Are you going to only cover Philadelphia? Because I'm not interested in Philadelphia itself. I'm more into the suburbs.
Okay. Well, Sandy, sorry, we're just doing Philadelphia County today.
Okay.
Any other questions, guys? All right, I want to keep this moving because, again, we're attacking this from a multiple different angles. Todd Miller of Bricknest Properties, rental guru extraordinaire. Todd, what are you seeing in the rental market? And I do have a couple of questions for you.
Yeah, thank you. And I have notes, so I apologize for looking down. It's interesting because, everything you said, Matt, we kind of contradict on the rental side. The areas along the Broadsheet Quarter in the Northeast, we're seeing longer days on market for tenants and rents not appreciating. Whereas Point Breeze, maybe some areas like Grace Ferry, some deeper parts of West Philly, like closer to Overbrook City Line Avenue, really far deep, the rents have skyrocketed. Now, I believe that is because they were historically low to begin with. So maybe they're playing more catch up than they are appreciating. Time will tell. But rents by average are flat-ish, and days on market are absolutely increasing. Now that'll lead into one of your questions, but I'll let you tee up the questions and I can give the answers.
Well, so I'm first of all, I will say this is not, I don't have this written down. This is just like me speaking of what's on my head. I am getting a lot of calls from either past clients or our new investors wanting to get into the rental market, seeing the opportunity, with prices starting to soften. So my question for you, Todd, is in your opinion, in a changing market, do you feel like it's a smarter strategy to purchase a buy and hold in more of a fringe transitioning location, or a tried and true location where you may not cash flow as much, but there's a little bit less risk with regards to the value suddenly, plunging?
Yeah, it's the $1 billion question. I personally like buying lower in the fringe areas and letting things catch up. But that's a reflection of my age, right? If I was 93, I don't think I would feel that way. But the opportunity will arrive now and sooner than we think to buy in the better areas, get a more quality tenant. With that comes a more demand for a nicer rehab. But I think it really just depends on your goals. If you're willing to wait for the cash flow, or if you want and or need it today.
So where are the areas? I mean, let's just throw it
Call
out
them
there.
out. Again, it depends on your goals, and I'm sorry for being cryptic and vague, but it almost has to be. If you're looking for the most amount of monthly cash flow that you possibly can, then I would absolutely encourage you to go to deeper West Philly, even parts of Grace Ferry where I invest. Certain parts of South Philly. Brewerytown is still great for that. Now Strawberry Mansion, I have friends buying there. Not so much more north of Temple, but that's kind of the cutoff for that.
So if I came to you and I said, listen, I want to buy a property and hold it, my goal is to hold it, for around 10 years, maybe not forever, are those locations that you'd recommend?
How much cash do you want to leave into it, and what do you want to make per month? Once I knew those answers, I can easily give you my opinion on that.
Okay. Well, I'm not going to answer that.
No, of course, it's a hypothetical.
Are there any recommendations that you would say off limits, danger?
More so on the tenant side, and it's one of your questions, but I'm going to kind of lead into it if I can. The only concern I would have about a new investor who would want to be a landlord today is to prepare for the tenant base to change drastically. The government has made it pretty clear with what they're doing with inflation now and the rates to raise unemployment, slow things down. Well, a result of that is going to be a harder time to screen tenants for whatever your qualifications are, is also within the guidelines, and then to be very conscientious of managing your business. And I'm seeing that personally, that it is becoming more and more of a challenge to find a tenant with 2-year job history, if that's what you're interested in, 6 months of cash reserves in the bank, whatever it might be. So if fortunately, I have a portfolio that can support a bad choice or two that I might make. But if you're brand new and if you're not in an area that's going to attract a doctor or whatever, whatever crazy example we can use, I would caution you with that.
Well, what's interesting, Todd, about what you're doing is first of all, you're not creating a market in Grace Ferry, but theoretically you could, if you bought enough properties, if you bought 12 properties on the same block, right? And you rehab all of them, you've just created your own little micro market. So it's possible to do. How do interest rates, and John, when we get to you, you can maybe jump in on this too. How do they affect the going cap rate? This is something that I've kind of struggled with listing multifamily properties.
Yeah, and thank you for saying that. I think it really applies to multifamilies only, because the single family is so easy to underwrite, right? If an interest rate is 8%, okay, well now my cash flow is going to be $65 a month, not $250 like it would have been at 5%, whatever the math is. But for a multifamily, it's very challenging. I struggle with it. I lean on Connor and John to check me and to help me on that. But I would say personally, and this would be my advice to people, is if you have the stomach for this, your opportunity to strike mainly in the multifamily game is going to be plentiful in the next 6, 12, 18, 24 months.
John, we'll get to you in a second, but just since we're on this topic, is there a certain, like, can you say you need to purchase at the cap rate needs to be at least 1% higher than the interest rate that you're paying in order, you know, to have it be worthwhile? Am I oversimplifying this?
I mean, when I'm talking to investors, you know, I don't really get into cap rates. I just put in front of them, hey, if you buy this house, you know, based upon the rate today, you know, your payment's going to be, you know,
Right.
$1,800, you know, and then they need to lean on Todd, yourself, you know, and say, hey, you know, what can this rent for? You know, the one thing we kind of run into, like when we're doing a no income debt service loan, you know, when rates are going up, you know, we're relying on that rent schedule, you know, to have that spread. So that's kind of tightened. So I have to keep an eye on that, you know, but a standard, you know, investment property interest rate, you know, I'm just going to provide it to them, you know, rates mid-6s right now for investors, with 25% down. And, you know, they'll have to do their calculation and say, you know, I think it comes back to what Todd says, instead of making, you know, $200 a month, you're going to be making $80 a month or whatever the figure is. But, you know, I put everything out to them so you can see, hey, you know, when you're making an offer on this property, it's going to cost you this amount of money, you know, per month.
Yeah, and Matt, the last thing I want to say, then I'm going to mute myself. To John's point, and to hopefully what Connor's going to touch on, this is very short term. We have to remember that. We have to be confident in that. I mean, if you look at the stock market growth from 1900 to today, it does this. It doesn't do this, and it doesn't do that. So my personal philosophy is, if you have some extra cash, if you're comfortable stomaching a little to no or even negative cash flow, but you're going to buy in an area that you like, get in, refi it at whatever the number is, tread as much water as you can. And then in 2 years, if you're at 7.5% and the rates go to 5.5%, fantastic. I doubt we'll see 3% again ever, or maybe in the near future, but it is going to improve. And it's important for all of us, certainly myself included, to remember that moving forward.
The reason I'm asking the question, you guys, is because a lot of times the investors that I work with who are buying multifamily take the income, they divide it by whatever the cap rate is to determine what the acquisition price is. And usually that cap rate needs to be higher than the interest rate. Otherwise, the deal doesn't make sense. Anyway, I don't want to get into the weeds too much. Todd, last question for you. You know, unemployment is increasing. That is the stated goal of the Federal Reserve. Does that impact in any way how you're qualifying potential tenants, or how you would recommend people qualify potential tenants?
I mean, absolutely. It is the biggest anxiety in my business right now. I have a lot of tenants that have gig work, right? They're Uber drivers or bartenders, baristas. They're just not 9 to 5. And when unemployment is going to be elevated intentionally, it's unfortunate, but typically the lower paying jobs are the first to go. And those people traditionally have the least amount of cash reserves and the most amount of paycheck to paycheck behaviors. So when you're vetting them, you have to set parameters within the state and local guidelines to really protect your business and your assets with your rental properties. And I'm happy to share offline some ways I've gotten creative, all kosher, but you just have to be really disciplined on that.
Okay, cool. Any questions for Todd, you guys? Thank you so much. Mr. Conor Reilly of Washington Capital Partners. Conor, in one word, what is a hard money loan, if anybody doesn't know?
Yeah, hard money lender. Really what we are is between a bank and a private individual who has a lot of money that can lend you financing for the purchase and renovation of a property. So we really fill a gap for those individuals that aren't yet bankable or need to close faster than a bank, and those that don't know just extremely wealthy individuals.
Got it. Cool. What are you seeing, Conor? I'm sure you're seeing a decrease.
Seeing a lot of things right now.
Okay.
Especially, you know, with the rates and the volatility lately. A lot of people are scared. There's been a lot of people pulling out of the market, or just kind of sitting back, waiting to see, what's going to happen. Those that make this their business, however, fixing and flipping or buying holds, this market shouldn't scare them. There's two reasons. One, the volatility of the rates is really important if you are a long-term investor, because as Todd was saying, you need to have, your rate, and then realize that your cash flow is still going to be, net positive. However, if you're a fix and flipper, the rate isn't as important. What's more
ARV.
important is speed of execution and, what you're purchasing at. So if you're able to build in your profits into your expected time frame from HUD to HUD, the rate itself from where we were as a hard money lender in May and June, I was at 7, and now I'm at 10 and a half. That 3% change really doesn't matter too much, because the prices are already coming down in terms of the purchase prices. What myself and my team is doing here at WCP is coaching clients and how to ensure that the deals that they're looking at, in addition to deals that they're looking at, will be profitable, in addition to underwriting things, extremely conservatively for them. And if the numbers check out with that, if they exceed that conservative number, it's just additional profit for them. So we're looking to make sure that people have multiple exit strategy and safe exit strategies.
I didn't write this down, but I'm just curious, and it may be too early to see this, but are presumably less projects in the pipeline, is that affecting labor at all? I mean,
yeah,
it is.
There's definitely some changes in that. Previously, a subcontractor can go from GC to GC and just pick up any job they wanted. Now, where there's less jobs out there, those that were job hopping are out of a job, whereas that loyalty and that, working within your sphere of influence now is paying off. I just spoke to someone yesterday where they were purchasing probably about 5 deals a month as an investor, and keeping 3 and flipping 2. That's how he was doing his cash flow. And he had about, I think he had 6 crews at that point. He's recently had to let 2 go. He's only has 3 active projects himself, but he's actually pivoted to turn some of those crews into GCs for either other investors or just homeowners looking to renovate their property. So there's definitely less work out there for subcontractors, but those that have been able to stick with their investors and their GC are going to continue to see work.
Cool. All right. So what can you offer an investor who gets into a flip, who gets to their, term date in terms of their construction loan, is unable to sell the property? Of course, this would never, ever happen with one of my listings. I want to get the disclaimer. Knock on wood. What happens then?
So it's kind of a twofold question. What is their plan and what do they feel is happening in the market? If they're confident things are going to turn around, in 12 to 18 months, what I'm seeing a lot of my clients do is we'll just do a bridge refinance, which means just a short-term refi of 12 to 18 months for them to ride out the storm, because our payments are interest only. So you're not paying on the principal. So what your payment was, you're probably paying around the same thing. If someone thinks that the market's going to turn in, 18 months, we'll give you that bridge. We'll give you that time to figure it out. Now, that's kind of banking on the market. You need to be very confident in your numbers and specifically your sub-market. Outside of that, you can go the Todd Miller route and turn that property into a rental. Now, doing that, you're going to have to understand what is market rate in that area. Or could this potentially be a short-term rental? What's going to give you the best cash flow? There are 30-year loans out there. There's also 5 and 7-year loans, which might be a better fit for some individuals looking to sell pretty quickly. And if it gets so bad, I've had this happen, 2 or 3 times in the past couple of months, where an investor just says, I am done. I want to be in real estate anymore. I've been burned too many times.
Oh,
yeah, we'll look to fire sale that property to another investor to just finish the project for them.
wow. Okay.
It's getting a little hairy.
Yeah, for real. Where are you seeing more transactions go under contract? On market
Yeah.
or off market?
Right now, I'm seeing more things off market. And the reason for that is because the wholesalers have already begun correcting the sellers, understanding like this is where the market is right now. With a lot of the properties that have been on market, a lot of agents, not Matt, have still been trying to push those numbers and trying to get top dollar, even if it's a property that isn't, truly livable ready or whatever it might be. So those investors that have been working with wholesalers historically now have that relationship and they're getting first dibs on these properties that aren't even being blasted. So for anyone here who's looking to, expand their portfolio or get into that, start having conversations with wholesalers in a more deeper fashion. Let them know what you're looking for, where you're looking for, how you'd fund it, so that they can come to you directly with a deal, because that's how you're really going to be padding your pipeline.
Just to jump off something you said, Connor, a hack that I'm hearing from people in different markets and people who I respect greatly, and this isn't foolproof, but it's just a way to check and balance pricing. Obviously, as an agent, if you are selling a property, you're going to be looking for the most recent sales, apples to apples. But one thing that I see a lot of people doing are going back and looking at comparable sales in 2019 and the first 2 months of 2020 before rates plunged, and just seeing how those numbers compare. If you're seeing some consistency in the numbers, it's probably a good indication of the market value.
Yeah,
All
that
right.
actually that brings me to something that I read about 2023 and where the market is going. Not to be fear mongering or anything like that. Goldman Sachs says that we're going to have a 5 to 10% correction, and that the bottom of the market is going to be the end of 2024. Moody's, who's a research company, has it as a 10 to 20% correction, and the bottom of the market being a 2025. I don't agree with that one. I'm in the mid 2024 camp, but I do see a 10 to 15% correction. So I would at least buffer in that much when you're looking at your comparables right now. And also that depends on what your construction timeline is. If this is a 30K construction, you can use the most recent comps because you should be able to get out in 3 to 6 months. But if we're talking a large development project that's going to take 12 months, you're going to have to be able to find different comparables and build those items in.
Cool. Any questions for Connor, you guys? All right, Miss Adamson from Keystone Title, thank you, as well as Elaine Miller. Connie, what are you seeing, first of all, with regards to closing volume over the past 30 to 60 days?
Hi, Matt. Can you hear me?
Yes, I can.
So in regards to volume is slowing down, but difficulty in transaction is on. The reason why I say that is because I'm seeing a lot of sellers that have owned their property.
Connie, your audio is kind of coming in and out. I'm not sure if there's a way to make that a little bit better.
How about now? Can you hear me?
Yeah, that's much better.
Okay, so volume is slowing down, but the transaction difficulties are on the rise. We're seeing a lot of sellers that have owned their properties for 20 to 30 plus years, which means the transactions, the clearing up title can get a lot more messier. I'm also seeing that forbearance modifications are around since COVID. Properties, people who have opted to do the forbearance program during COVID. These are actually second mortgages. So now, first and second, you have to get 2 payoffs. The second payoff, and they come from HUD. So you have to get the actual second payoff from HUD. So that could take some time as well. And a lot of people, some people may not know that it's a second mortgage.
I did not know that's a second mortgage. And you're saying the payoff takes about a week to obtain?
It takes some time because you have to get it through HUD directly. So you're getting first mortgage payoff, but now you're getting the second one.
Interesting. Are
Yeah.
you seeing any patterns? I know you guys are closing deals not only in Philadelphia, but in all of the suburban areas. What are you seeing in terms of patterns of location of properties that are closing, meaning where people are purchasing?
I'm seeing it consistent throughout all 5 counties. It's all consistent.
Good. Well, that's good. That's not what I was expecting you to say. Okay. What sort of, since you get to, go through all the loan documents, I think you have a really unique perspective and be able to see what exactly sorts of financing people are using. Are you seeing, a lot more creative uses of mortgage instruments that weren't being used even a year ago?
I am. And when you speak to John Casey, he can get you some more information on that. But I'm seeing interest-only mortgages with a 30-year amortization.
I will have a question for John on that, so I'm going to write that down. Okay, what else?
And I'm also seeing the balloons, the arm loans.
Yep. Okay.
That I'm seeing a lot lately.
What, Conor just mentioned he's seeing more off-market purchases and on-market purchases. An investor may not know, what deals have the likelihood of having a potential title issue that could hold up the transaction. What should investors look out for when they're purchasing properties privately?
Okay, so I feel like they just need to get a title search up front, and they
Okay.
can order me.
All right.
It only costs, close to like $200, but you're going to actually see what's going on before you decide to purchase. And I believe that if you list it on MLS, stating that you're going to use Keystone Title Services, for example, the title search has already been done, which is a plus. And what you've paid, you can use that as a credit towards the buyer's closing cost or title.
Okay.
So that $200, say if that's for the title search, it can be applied at closing.
And Connie, how long does it take? I mean, if I were going to be buying an off-market property, and let's just say I wanted to include a very short contingency in my offer just to say, look, I don't want to be bound up into this deal while title tries to work out all these kinks for, weeks or months. How long would a title search, take roughly?
A few days. I can get it.
Okay. All right. And lastly, a lot of investors will purchase, that I work with, will purchase estate properties. They know a neighbor or a friend or whatever, and a estate property comes up for sale. A lot of times estate properties can have some unusual title issues. What should an investor, if they're buying an estate property privately, what should they be asking the seller for upfront to avoid getting into a situation where it takes 2, 3, 4 months or more to close?
Are the estate docs filed? That's your first question. Your second question is, are you the one in charge? Do you have a will? All of those questions are very important because if someone died without a will, you still have to file intestate. So that could be, a little bit of time. There's also inheritance taxes that are going to be having to be paid. Most of the time, title companies, they escrow that at closing until the estate, until the inheritance taxes are, figured out.
Would you
So
say if there's an estate attorney involved, that generally that's a much better sign that there aren't going to be problems, or not necessarily?
No, most people will use an estate attorney or an accountant that will file their inheritance tax information. It's really good if there is a lawyer involved because they know what they're doing.
Right, that's what I
Those
mean. So if
people
there's
just-
not a lawyer involved, would that be a red flag for you, or at least a yellow flag as a buyer?
If an attorney was not involved,
Yeah,
I see a lot of people, they just go over to the inheritance office trying to file stuff, and they have no idea what to bring, what they're supposed to be doing. So at least if they pay the extra money, they know it's going to get done the right way.
okay. So I just want to make sure that you're answering the question that I asked, because it's important. If you are a buyer for a private sale that wasn't estate and there was no attorney involved, would that be a red flag for you? And should that? Okay, yes.
Yes.
Okay. Cool. Any questions for Connie, guys? All right, Mr. KC from Guaranteed Rate Affinity, thank you for joining us.
Thanks, Matt.
What's the interest rate going to be in April 2023, John? No, I'm just kidding. What is going on with interest rates right now? And why have rates, I think everybody wants to know how the federal funds rate has continued to go up, and yet mortgage rates have actually gone down a couple of times, and it's really confusing. Can you help demystify this for us, please?
So you asked the $1 million question as far as where rates are going to be. I was just actually
Please
on a
don't go
call.
into all the bonds and everything. Like,
I'm not going to go. No, we're not going into that.
down. Yeah.
So I was actually on a call right before this with the CEO of my company, and he put out there that in the next 60 days, he sees interest rates being at 5.5%.
Oh, interesting. Okay.
Take it for what it's worth. But yeah, I mean, 2022 has been
Can you say why that
unprecedented.
is?
Yeah, I mean, you see inflation over the last couple of months has come down a little bit. Unemployment's starting to rise. Those are two big indications of, potential rate decreases. So, we'll see. But what I was saying is 2022, it's been unprecedented as far as interest rates. I just look back, this time last year, 12 months, a 30-year fixed rate was at 3%. Now we're sitting at 6%, so the drastic difference, really, I think, unnerved some buyers over the summer where they were like, rates keep going up, up and up. And they were, now probably on the sidelines seeing how this is all going to play out.
Yes. So here's a question, we could get into a very long debate about this. By the way, you guys, my parking meter runs out at 2 p.m. on the dot. I've got 4 parking tickets this week. I don't intend to get one today, so we're going to chop this off before that happens. But John, what would you say? Because people are going to hear you say that and say, I'm going to wait, whether you're a buyer or a seller, I'm just going to go ahead and wait, until this gets more stable or more favorable. And, on the surface, that thought seems to make sense. And yet as an agent, what goes through my mind is, okay, well, what if, once things become stable, all of a sudden everybody has the same idea and lists their house on the market, or all the buyers come in the market at the same time? Do you really think that that's a good idea? Or would you say to somebody, hey, if the property makes sense and the payment makes sense, now's the right time to pull the trigger, regardless of whether things inch up or down 1/4 or 0.5%?
Absolutely. I mean, if you're ready to buy a house today, right? There's less buyers, quite frankly. So you're not getting into that competitive situation of 5, 6, 7, 8 offers where you're losing out on 5, 6, 7 houses, right? You're maybe getting that house at a discount or at market. You're doing an inspection on the property. You're not waiving all your contingencies. So now I think it's a great time to buy, because then, you're in your house. And again, down the line, you can always, if rates drop for whatever reason, you always have that, the option to refinance, to take a lower interest rate and just better your position. Because if everybody waits and says, all right, let's wait until the spring and let's buy then, we could be back to that same position we were 2 summers ago, where you have all these buyers and they're all making multiple offers. You're going above asking price, and you could have bought the same, a house similar for less, less value. Yes, the rate's slightly higher, but your payment could be higher in the springtime.
Yep, good, I agree. I know this is speculative, but do you think we've hit the ceiling with regards to rates? I mean, is there a likelihood that we will see 7.5, or 8%?
So in October, we hit 7%.
Right.
It was very
Oh,
brief.
I'm aware. I'm
Yeah.
very aware.
And it sound. I mean, the alarms were sounding. I mean, it freaked a lot of people out. I think, unless I don't see inflation going back up again. So I think we have peaked, at least at this this wave, because again, like Todd said earlier, I mean, rates, we're on a wave. I mean, and we're catching it, on the higher side now, but it's starting to decrease. So, time will tell. That's the worst thing about interest rates, is trying to predict them. But, I think, the fears of, 8, 9, 10% interest rates that some were talking about, that's not going to happen.
Well, and I think it's important for people to keep in mind, those higher rates have been fuel for a potential seller to lower prices. So as rates start to go down and level out, buyers may think that they're getting a better deal, but I work with a lot of sellers, and I can tell you the sellers are going to start digging in on prices as they start to see more stability in the market. So I'm totally in agreement with what you're saying.
Yeah, I mean, I think stability is one of the biggest things, is because this market, with the rates jumping from 3 to 6, that's not stable at all, right?
Yeah, no.
But again, if you've been in the business long enough, or you can educate these first time buyers, 6%, 10 years ago was a great interest rate. We all bought houses at 6%. We bought houses at 7%. So it's doable. And that's kind of we have to educate and say, the days of the 3% of the artificially low interest rates right now is not a thing. So if you're looking for that, you probably don't want to buy. You have to give them the value of the reason to buy it, at 5, 6, 7% interest rate.
What sort of creative solutions are you using for buyers? Connie had mentioned interest-only loans. Why would somebody do that? Is that a qualification thing?
I mean, yes and no. I mean, interest-only loans are for more, buyers that have a lot of cash, that are putting 30 to 35% down. A lot of time in this market, we're dealing with first-time buyers that are, FHA or 3% down conventional. Nobody's going to offer an FHA or an interest-only loan. You have to have the equity in the property, because of the risk of, you're only paying interest, you're not paying down the principal. So, yeah, I mean, some of the creative products, I mean, there's the buy downs where, say today's interest rate is 6%. You could do a 2-1 buy down. So the seller pays, let's just call it, usually it's about 2.1% of the loan amount, where they buy down the interest rate. So the first year it would be 4%, second year 5%, third year would be 6%. So they don't have, that big shock of the 6% right off the bat. They can kind of ease that into that, and still have the opportunity, if rates do become available, they could always refinance as well. So that's kind of the big.
More favorable than an ARM.
I do. I mean, ARM rates are slightly lower than 30-year fixed, but the spread is not.
It's not enough. Okay.
It's not enough. I think some of these people that are doing ARM rates are just saying, that they, for whatever reason, they want to grab that extra 0.25%, or, I'd recommend probably taking a 30-year and doing a slight buy down if there's a certain rate you're looking to get to. I just don't see the need for ARMs right now.
Got it. My last question, I don't know if you know the answer to this or not. Do you think, what about assumable loans? I mean, I guess you really wouldn't be involved in that, would you?
The only real loan you can assume is a VA loan, and I rarely see it. A lot of VA guys are moving on to another house that they want to use their eligibility. So really, there's not much assumption with mortgages, and it's another key piece. I think rates, are they going to be at 3%? No, but here's the thing: we now have this whole pool of people who have refied or bought in the last couple of years that now have rates, that start with 2 and 3. For them to buy or sell, to me, like, if you're in a house at 3%, are you going to take 7 or 8%? Probably not, but could you stomach 4.25%, 5%? Sure. So I think that's going to weigh a lot in the, down the line as far as where rates are going to head.
John, quick question, John. In your last 10 loans, how many of them were buy down versus a regular conventional or FHA mortgage? Do you see a lot of people doing them?
No, I think it's more of a marketing ploy. But I mean, it has to make sense for both the, for both the buyer and seller, right? I think it makes a lot of sense for buyers, they're getting a benefit, but the seller, they have to understand, is it better to do a buy down versus a price reduction? That's the conversation as the listing agent needs to have with them and saying, hey, you could do a 2-1 buy down and it's going to cost you $10,000 instead of reducing the price 15 or 20, you may be able to net them an extra 10 grand.
I'll tell you what I did. Yeah.
Go ahead, Frank.
Yeah, I was going to say, so what I did on the 2 that I did over the last 60 days, we wind up increasing it, use the sale price, just like kind of like a seller's assist. We did it the same way. So instead of
Exactly.
460, we sold it at 470 and 468 to be exact. But that's kind of what we did. We just increased it on the end.
Yeah, I mean, essentially it's a seller assist. So yeah, you increase the price, the appraised value is there, and then for that case, the seller, walked away with the same amount they would have sold it for at 460, and the buyer's happy because they have a lower interest rate to start.
I have to tell you, when it first came out, I thought that I was going to my clients. I thought it would be something I would be doing more of, and I'm surprised that a lot of people are not doing it. That when you look at the numbers, and if it's now like it is now, 6%. I think when it was over 7, it made everyone look a little more. It was a little more appealing, and I think now that we dropped down to 6, I think that was a big difference.
Yeah, I mean, I think psychologically with interest rates, when we're talking now, if I could say interest rates are in the 5s, I think that's going to put a lot more people at ease than saying, now your rate's 7 or 7.25 or even 6.75. I think that psychologically, if we can keep it under, at or below 6, I think, we're going to see a good spring market.
Yeah, me too.
Guys, any questions for our panelists? I see some questions here in the notes. Rupert, which areas would you recommend fix and flip where the projected ARV is 400 to 500? My bet is just Mount Airy. That's where I've got a bunch of clients who are working in Mount Airy and Roxborough at that price point. The end products seem to be moving quickly. You can acquire and renovate and make a profit and hit all of those, all of those pressure points. So that's what I would say. There are lots of other areas where it would make sense, but that's the one thing that comes to my mind immediately. Any other questions, guys? All right. Well, thank you, everybody. Thank you to Todd, Conor, Connie, and John for sharing your expertise. I think this has been an amazing conversation. And happy holidays, everybody. We'll see you in January.